Hello everyone, this is Andrew McNair from SWAN Capital with our October 2023 SWAN report. In this month's video, we're going to discuss some recent headlines that influence the financial markets. But I want to provide you some perspective on what these developments may mean for you and your portfolio and your retirement plan over the next few months ahead. Now, as always, please stay tuned at the end of this video for a required disclosure statement. We don't want people running around using this report as personal financial advice. Again, it's just a market commentary. At SWAN Capital, our market outlook is cautious because of world conflicts and higher consumer credit. This month, of course, took an unexpected turn when another major international conflict erupted between Hamas and Israel, and we haven't even come to a resolution between Ukraine and Russia. Thousands of lives were lost, and a lot of uncertainty surrounds this conflict. We often talk about the possibility of an unforeseen event dominating markets when we try to estimate what direction the market will go. Well, usually those events are geopolitical and completely unexpected. That's why we call them black swan events. They come out of nowhere, such as this war in the Middle East, making it even more imperative to properly control the things that we can control here in our personal economy and here in the United States. Here in the United States, we need a functioning government. We need responsible fiscal policy, lower inflation, and affordable and abundant energy, and thriving consumers. Then, if we do get blindsided internationally, we can keep functioning even though recovery may be difficult. We have a lot of sadly manufactured, self-inflicted problems this time around, and less room on our financial and emotional shelves to deal with yet another major crisis. The Israel and Hamas situation could potentially get bigger and uglier quickly, and markets may not handle it well given what is already on our plate. It's sadly a time when we have a lack of leadership in Washington that people are having these geopolitical concerns and conflicts because of our lack of leadership. Whatever we like it or not, the markets are based on mood swings. And we call this market sentiment, but these are just market mood swings. And the current market's mood seems to be bad. Lots of people are exhausted. Their savings are exhausted, and sadly, they can't turn to running up their credit cards so they can get even satisfaction from buying something that they don't really need. It all feels off at the consumer level. Now, earlier this month, a small group of Republicans, no names will be mentioned, sadly seemed to blow up the House of Representatives and throw the government into a new state of turmoil when they forced a vote to remove Speaker Kevin McCarthy. Now, Kevin McCarthy probably should have been let go because of the budget dust-up, but that's here nor there. You always have to have a backup plan with multiple speakers on the batters up when you get rid of a speaker, especially when this is the first time ever a House Speaker has been booted from the position. We've previously said there would probably be fewer or lower hurdles to jump through in the second half of 2023, and that markets would likely push higher, but these self-inflicted wounds seem to be getting to be too much for the market to handle. These mind-boggling miscues are coupled with the Fed fixated on lower inflation. Higher interest rates are giving people options they didn't have in a zero-rate environment. And so you can imagine the consumer who's been in this desert of low interest rates sees an oasis of higher interest rates, but forgets that they're in a desert of inflation. So they're flocking to higher interest rates, which is coming at the expense of equities. As long as rates remain at these levels, the cost of doing business for businesses will remain higher, and the earnings that these businesses have will suffer. Plus, the market will likely limp instead of roar back into the year end, and a promising year will have been frittered away. The government also needs to stop spending immediately. We have added over $10 trillion to the deficit since 2019 alone, without any tangible benefits to the consumer, to the citizen. We spent money we did not have on things we did not need. The solution seems to be simple. curtail spending, government spending immediately, which will help lower inflation and allow the Fed to back off. That, however, would require leadership, not politics, and leadership is, I guess, non-existent these days. The minutes of the last Fed meeting were also released and revealed that the Fed was inclined to delay additional rate increases. Now, when you dig deeper, the minutes also showed that the talk was more about potential additional increases and what would drive the economy for the future. But the reality finally caught up with markets as the CPI, Consumer Price Index, came in at 3.7%. The Fed's preferred core CPI dropped to 4.1%. The continued decline is enough to keep the Fed idle, but it underscores what we've noted before, that the difficulty of taking inflation from 4% or more down to 2%. Now, the Fed leaders are faced with the realization that if they move further and faster, they could break something. But if they do nothing, inflation and rates will remain at these levels. Now, ultimately, that will strangle the economy, so something has to be done with inflation soon. Now, if we look at the payroll reports, the ADP employment report, if we look at the job market, we can see some interesting things. We can see that the Bureau of Labor Statistics, the non-farm payrolls, came in at 336,000 jobs, which blew away the consensus estimate, and it was significantly higher than the August numbers. Meanwhile, the unemployment rate stayed at 3.8%. So you have to ask yourself, will these numbers stay the Federal Reserve's hand at their next meeting, or will they look to raise interest rates once again? So we're keeping a close eye on the Fed, more than I'd like to, in this high interest rate environment that we're approaching. And with the Fed increasing interest rates at breakneck speed, we have to keep a close eye on the Fed, which I'm not a big fan of, because this is, again, America, not the Chinese government that we're focusing on what controls interest rates and the bottom line. But this has been a lot of political chatter. I'll save you and I'll get down off my podium. That's it for this month's SWAN report, but I want to encourage you to take us up on your wealth review. If you want to talk about your personal financial situation and how this news affects your portfolio and your retirement plan, give us a call at 1-800-848-8768. That's 1-800-848-8768. 8768, and we look forward to seeing you on our next month's SWAN report. See you then.